If you have 50,000 and want to scale to $500,000, what would you do? In this video, I'll break down a popular option trading strategy known as LEAPS, short for Long-Term Equity Anticipation Security. We'll be covering what LEAPS are, how they work, why they are so powerful to long-term investors, and most importantly, the risks you need to watch out for. Throughout the video, I'll be using Tiger Broker Singapore app to demonstrate how LEAPS works. And if you haven't signed up yet, you can use my link in the description below and you can get 1 free stocks and $300 cash rewards. Let's dive in. Why use LEAPS? LEAPS are simple option contracts with longer expiration date, typically 1 year or more. Why does it matter? Because one option contracts give you control over 100 shares of stock, and LEAPS let you do it with much lesser capital than buying it upfront. Think of getting stock exposure with the same kind of leverage as margin, but without paying for margin interest. LEAPS have a longer runway since they expire far in the future. They give you time for your investment thesis to play out. This is a very popular option strategy for long-term investors, especially for bullish bet using deep in the money call option, which behave similarly to owning the stock but require less capital. Let me show you an example. Let's take a real trade example. Say Apple is trading at 196. Instead of buying 100 shares for 19,600, we buy a deep in the money LEAPS call with 155 strike price expiring in 456 days, which is 1.5 years. This might cost you 5,633, significantly lesser than buying 100 shares. So now you are controlling 100 shares, but with 14,000 less capital. You can reinvest the saving elsewhere and potentially grow your portfolio even more. So before I dive deep into LEAPS, let's understand more about the intrinsic and extrinsic value. Every option premium has two parts. Intrinsic value, the real built-in value, which is the stock price minus the strike price. The second part will be the extrinsic value, which is the time value, and it decays every single day. So for this example, 169, which is the current share price, minus the strike price of 155, which gives you 41. So for our Apple example, the intrinsic value will be 41 times 100 shares, which is 4,100. When we talk about the extrinsic value, it means the premium that you pay, which is 5,633 minus away the intrinsic value. So the extrinsic value will be the remaining 1,533. And that is the part that will slowly disappear as time passes. Let's look at three scenarios. Scenario 1. Apple skyrocket to 250. So for stockholder profit, they will profit 5,400 because 250 minus 196, which is 54. $54 times 100 shares, which is 5,400. And for LEAPS holder, your profit will be slightly lower at 3,867. How do we get this number? You get 250 minus the strike price 155, which is $95. $95 times 100 shares, which is 9,500. 9,500 minus the premium that you paid, the 5,633. So it equals to 3,867. Scenario number 2. What if Apple falls to 155? So for stockholder, you will lose 4,100 because we use the current strike price 196 minus 155, 41. 41 times 100, so it's 4,100. And for LEAPS, your intrinsic value is 0, extrinsic value is also 0, but you pay a premium of 5,633. So this will be your max loss. LEAPS holder lose the full premium of 5,633. The risk is similar, but your loss is capped at your premium. Scenario number 3. Apple crash to 0. Stockholder will lose 19,600, but LEAPS holder only lose 5,633. So with LEAPS, you risk less and still get similar upside potential. By the way, if you are getting value from this so far, do me a quick favor, hit the subscribe button. I break down strategies like the real strategy, covered call, and real portfolio updates every single week. Alright, now back to the video. Let me walk you through exactly how I'm using LEAPS in 2025. It starts with only one simple rule. I only trade LEAPS on company I'm happy to own over the next 5 years. No hype, no junk. For me, that means names like Nvidia, Google, Microsoft, and Meta. These aren't just popular stocks, they are companies with strong cash flow, deep AI exposure, and real competitive moat. They are the kind of stocks I can sleep well owning them long term. Now, once I've picked the stock, here is what I will be doing. I buy deep in the money options, long dated call options that expire 1 to 2 years time. But here's the key. I look for options with delta of zero point 0.7 or higher. Why? Because they behave more like the stocks. They got less time decay, more intrinsic value, and higher accuracy when it comes to break-even points. First, delta, which is the price movement of the option price, when the underlying stock price changes. For example, if the option delta is zero point 0.8, it means the option price will move zero point 0.8 whenever the underlying stock prices move by $1. Other than that, position sizing is just as important. I never go all in. That is how people blow up their account. For LEAPS option, I usually go for just 10 to 20% of my portfolio size. This structure gives me leverage but also control. That is how I grow without gambling. Now let's talk about risk because yes, even with a strategy like this, LEAPS aren't risk-free. But the way I approach it is not a gamble, it's calculated, constructed, intended. Here is how I protect myself. First, I don't buy out of the money call option because that is not a strategy, that is a lottery ticket. Second, I only buy LEAPS on companies I'm happy to own. If I won't hold the share for the next 5 years, I'm not touching the option. Number third, I try to avoid earning events. Earning can move stock wildly in either direction. I would rather not leave that up to chance. Fourth, I never go 100% into LEAPS. I keep cash buffer both for safety and opportunities when the market give me a better entry. And lastly, I always have an exit plan. Before I enter a trade, I know my maximum pain level and my targets. If a LEAPS position move against me, I don't panic, I follow my rules. I might be rolling the option down to a lower strike, locking in some values, or I will roll out further in time, buying myself more runway. And sometimes I will just take the loss, cut the dead weight, and move on to a better setup. Because the truth is, not every trade will be a winning trade. But if you manage your risk, size your position, and stick to high quality names, you don't need every trade to win. This isn't gamble, it's risk defined leverage, and that is how real wealth is built. For those who are ready to jump into option trading, I personally use Tiger Broker because it's easy to trade options. You can find my referral link in the description. If you sign up through it, you will get some bonuses and it helps support the channel. If you find this video helpful, don't forget to subscribe for more strategy like this. Thank you for watching and I will see you in the next video. Until next time, trade smart and stay profitable.